It seems like bank review work is picking up.
It's really just due to the economic environment and interest rates.
Everyone out there wants to know, how do we get on those lists with the banks?
I always joke with my colleagues that part of our position is talent scouts.
If I'm talking to an appraiser at an event, that appraiser is really wanting to perform quality work and is really interested in being a good appraiser. That goes a long way.
Welcome back to Face Value by the Appraisal Institute. I'm your co-host, Warren Boisot, and we are excited today to have kind of a unique situation. Tonia and I were asked to be in Clearwater, Florida recently for the REVCO. We had a panel discussion that we led with three wonderful guests, and we thought, what if we make that into a podcast? So that's what we're doing today.
That's right, Warren. I'm Tonia Vilas, your co-host for Face Value. Today we welcome three of our panelists that were with us in Clearwater. We can start with Elaine, Justin, and Mike. They have come to talk to us about bank review, something that many appraisers work on. They complete appraisals for banks, and these are some of our review panels. So we can start a little bit with Elaine, and then Justin and Mike, and let us know a little bit about yourselves.
My name is Elaine Liz Plowman. I'm the chief appraiser for Hancock Whitney Bank in Gulfport, Mississippi. I was a field appraiser for 20 plus years, and I've been in banking for about 15 years.
My name's Justin Slack, and I'm with WaFd Bank, headquartered in Seattle, Washington. We're about a $30 billion community bank in 9 western states, kind of west of the Rockies, down to Texas and over to California. And I've been in this position for almost 4 years, been in banking for a little over 16 years. And before that, I was also a fee appraiser out in the field.
Hi, my name is Mike Seney. I'm with South State Bank. We are a $65 billion bank headquartered in Florida, service most of the Southeast and now into Texas, Colorado, and now Tennessee. Prior to joining the bank about 6.5 years ago, I was a fee appraiser for almost 25 years.
Now, before we started this podcast, we were talking, Elaine and Justin were talking a little bit about how work is going. And it seems like bank review work is picking up. Can you tell us a little bit about what type of properties you're seeing in the bank review world right now? What kind of underwriting issues or mortgage financing that is coming your way?
Hey, so I'll take that, Tonia. So we have really increased in volume on the commercial side. And as of last week, our residential unit started experiencing a higher volume of requests. We are seeing some special asset and workout properties on both residential and the commercial side. I think it's really just due to the environment, the economic environment, and interest rates, which obviously affect property values and the ownership of those properties.
Yeah, I'll echo that. We don't do any residential, but on the commercial side, also seeing special assets increase, which kind of are problematic. They might have issues.
Our special assets has ticked up a little bit, mainly from the SBA space. We're a pretty heavy SBA lender. And so our SBA small business area has seen an increase there. Commercial side has increased a little bit.
For those of you that do handle residential work, just talk us through the basics of the workflow or how the appraisal review process works.
We do residential for like home builder finance. So not for borrower base, but for a builder. And it's the same. So get the appraisal order, get it engaged with an appraiser. It comes back. Our team reviews it. And then if there's any questions from our team, we go back to the appraiser and ask for any clarifications.
Everyone out there wants to know, how do we get on those lists with the banks?
Yeah. So for us, the process is to basically email me. Here's the biggest issue with getting on those lists for at least for our bank. Our list is pretty full already. Honestly, we have too many appraisers for our list. But we're pretty loyal people. Once you're on our list and you're doing, good quality work for us, we want to maintain a relationship with you. So we try to build that list too strong because, otherwise I've got 15 people clamoring for 3 jobs. So that's unfair to everybody. So we try to keep the list to, good appraisers. We do have some markets where we've got some need. And while we are very supportive of young appraisers or new appraisers getting into the market and getting work, because we need those appraisers to get moving. It's difficult right now. It really is. But all you can do is ask and try, right?
How does your rotation work? How is it? Is it random? Is it who's best fit for that geography or where complex property, who's best at that? How does that work?
Yeah, that is a fantastic question. So the way it works for us, the first thing that happens when that request comes in from our lender, we take a look at that property or that request, and we take a look at it and we decide, is this a complex deal? Is it a simple deal? What does it take to do this? So when we pull up into our system the list of appraisers in that geographical area that we feel like we would want to use, we do kind of go through those and identify the appraisers we think are most likely to do a pretty good job on this particular report. Not everybody can handle all things, so we try to identify the handful of appraisers that we feel like would be successful in this endeavor, and then we bid out to those. So that's how we do it.
And Elaine and Justin, how can we get on your list if you had availability for us?
Well, I think it's the same. We'll probably get emails as well after this call. But so we do, I agree with Mike. We try to limit the number of appraisers. We want to feed all of our appraisers. So our list is really based on if we have an available spot to add an appraiser. And I would agree on the residential side, we have an auto rotation for appraisers. One other thing that I wanted to bring up is that we rate appraisers. So we have a rating scale ABC. And so we qualify you based on complexity. So anyone who is bidding that out amongst the team, they have that information.
Yeah. And then very similar process, depending on where we're at, right? So in some markets, we have a plethora of appraisers. In other markets, for other property types, we don't. So to Mike's point, we don't want to just add people to add people. We just went through an FDIC exam, targeted exam for appraisal. And the first thing they ask for is our approved appraiser list. And then we have to make sure we maintain all that. So we have to maintain your license, your insurance, your application. You said, hey, I haven't got a bid from you guys in 3 years. Do I really want to keep doing this? And I understand that. So it just really depends on the market areas and the property types.
So for someone coming in, it seems like it's very difficult to get into the banking appraisal world. What are your recommendations for someone who's entering this field, not so much new, but who just started their business and has been doing this for a long time?
Maybe they just went on their own, but we see a lot of appraisers with firms that co-signed a lot of reports that may not have been our approved appraiser, but maybe did a lot of the work. So we're happy if they move on their own or move somewhere else. We're happy to talk to them. And to your point about a member meeting, so I always joke with my colleagues that part of our position is talent scouts. So we try to go to those chapter meetings. I'm a big proponent of going to chapter meetings where you can network with those people.
If I'm talking to an appraiser at an event, I kind of get the feeling that appraiser is really wanting, to perform quality work and is really interested in being a good appraiser. That goes a long ways to meet somebody at some of these events, rather than just somebody emailing me out of the blue or give me a call out of the blue. I don't have any way to kind of judge their character, their involvement in the industry. Those kinds of things would go a long way.
We're on your list now. We want to stay on your list now, and we want to do a good job for you. Elaine, you kind of touched on it earlier, but maybe let's dig a little deeper into that point system or how you rate appraisers within your own companies.
Yeah, so the expectation from the regulators are that we score every report that we read. So we have actual characteristics of the report that we score. I know all the banks do. It's really a requirement. And so when the FDIC comes in or your regulator comes in, they want to know, what are the appraiser scores? They also want to know what are my QC scores for my internal team. And they really focus on the lower scores. And, they ask you, what are you doing? Are you, getting rid of these people? Are you getting them off your panel? And I am not a proponent of that. I'm a proponent of really helping appraisers succeed. And what I say to the regulators is, sometimes people have a bad day. So if you're an A appraiser and you have a bad day, we lowered their rating to a B, and we'll try them there for a while. So my opinion is you need to stay in touch. This is business. Appraisers are not good at the business side, but this is the business side. And the business side is you need to maintain relationships with your customers, and your customers are banks. And so talk to the chief appraiser, talk to the appraisal managers and ask them, why am I not getting work, and don't wait 5 years to do that.
Yeah, we use a 1 through 5 system, 1 being the lowest, 5 the highest, similar to Elaine's. They wanted to know, the FDIC examiners wanted to know, what are we doing to train up the people that might get a lesson, like a lesson 2 or a below, a 1 or a 2? Why are we still using them? Our system is based on, most of the weight is given to quality of work. And then we have timeliness, we have responsiveness. But to Elaine's point there, it's very important that, like, responsiveness is big for us. Like, we try to think we're teammates. Like, we're trying to get across the finish line together. So when we have questions, we're not doing it because we have nothing better to do. We're trying to get this across, but also just being on time. And they'll say, hey, something came up. I mean, life happens to all of us. It kind of hurts us because there's expectations when people are closing. The timeliness of these reports, just getting them on time, which seems a lot of assignments aren't on time, which is challenging.
Didn't you guys all kind of agree that 20% of the time appraisers are late, which shocked me?
And what are some of the big mistakes that people make in their appraisals? What are some things that could get reported to the states?
That's a question we had, because the question was, how many people did we report last year? And I said 0. We're more trying to work with appraisers. So, I guess if it was like gross misrepresentation, what's the most mistakes I see is this not reading the engagement letter, which again sounds silly. That's the assignment, but the engagement letter, just reading the engagement letter, is where most of the issues that we see that would have caught most of those things.
I'm going to say my biggest pet peeve right now is highest and best use. Have appraisers missing the highest and best use. I also have some of the larger firms are bifurcating inspections. We literally had one where the inspector could not go in the building because it was dangerous. And that was never on the form, never asked. The appraiser didn't know. They just had a third-party inspection. Another thing that I'm finding recently is when we, as a user of appraiser services, we disclose that this is for an FRT, a federally related transaction, mortgage transaction. I find that the appraiser is not, by USPAP, they're charged to understand the appraisal problem and the borrower's interest in order to give us a credible value.
Yeah, those are two things. I think part of the two things of scope of work and highest and best use kind of go hand in hand. A lot of times people don't understand what you're asking, and they fail to communicate that to the client. And I think that's another big key here is communication. So Justin, you touched up on the appraiser not contacting the client if they're late. This is something they should also contact the client. I don't understand the scope. This might affect highest and best use. And I'm really tired of reading appraisals that have a 2-line highest and best use. The highest and best use is continue as its current use.
I would think too, Tonia, like with banks like ours that have appraisal departments, you can contact us anytime. And again, it's also like know your client. It's a partnership and we have to get across the finish line. So we only know the information that we're given. We try to do some research, but we don't get everything. So if something happens, we try the best that we can to help the appraiser, and the appraiser should use us as resources along the way. If they don't understand the scope or if something changes, don't just give us something like, oh, that's, because again, we might then be calling them back after the fact saying, hey, we need to re-engage you for this, even though you put it away, you put it to bed, you filed it away, but we can't, to Elaine's point about an FRT, we can't really use it now for what the intended use is because we didn't know, but you found out, so.
I think the old adage was, the appraisers are, the eyes and ears for the customer or the bank client. And I think the new generation of appraisers maybe need to hear that.
Yeah, communication. That if there's one phrase or one idea that should be taken away from this is that. And going on, talking about what Justin and I were talking about earlier with the relationships with your bank or whoever's hiring you, whether it be a bank or somebody else, having that relationship really helps with that communication. It's much easier to pick up the phone and call than with somebody you've got a relationship with than someone you've never spoken to ever. So, having that relationship is very, very, very important. The other thing that I would, first of all, kind of like the highest and best use, we'd like to see what we call the money paragraph. So it's great that you gave us 68 pages of data, and stuff in a commercial report, or if you've got all kinds of stuff for a residential mortgage, that's awesome. That's great. But tie it in and have it, mean something, and tie it into the subject property and to what you're actually valuing. Otherwise, get rid of the 68 pages of data, because it's too much.
Yeah, talking about the history of a state when it was founded, in 1812 or 1843, unless it's tied to the property, like you got a historic preservation or something on it, or you're valuing the historic significance of this landmark, then otherwise, to Mike's point, not necessary. I'm still seeing reports about COVID, the onset of COVID, and the uncertainty of what's happening in COVID, and no one knows. I would say we're beyond that. If you want to talk about the aftermath of COVID and how cities are coming out of COVID, great. But when you still say there's a lot of uncertainty, we don't know if the states are going to shut down, that just got left over from a report from 5 years ago this month, or type of things. So,
well, they just don't read their boilerplates. They don't update their boilerplates. And it really does drive me nuts. And Warren, I know you do residential work, and I'm assuming it's mostly form work. But on the commercial side, when we have these 120-page reports, and maybe you can narrow it down to 40 pages of quality substance in the report, it makes me not want to read it.
Same thing. Well, I'll say on residential too, I still see things about the great financial crisis, 12, 15 years ago. And again, if there's something that's tied to that, like if your market hasn't come out of that yet, or you're mimicking that, or you're worried about that, great. But talking about the interest rates were at an all-time, high back then, and defaults were super high. Unless you can tie it to today's action, like whatever's happening in the market today, there's no reason to have that there.
Do you see like the life cycle of real estate? Do you see that pattern? Or how do we do that better?
I would say the genesis and the issues that were facing us 12 or 15 years ago are different than right now. I would say if it's related to it, great. But if you're just saying that 12 years ago there was a crisis, but it's unrelated to this, and it doesn't mirror this, or doesn't, even though they both were cyclical.
Speaking about your individual markets, and we talked at the beginning about everyone seems to be maybe an uptick in getting a little busier. What about your particular markets as far as delinquencies or foreclosures, short sales? Are you seeing anything up or down or different about that in your markets?
Yeah, I would say we do have an uptick in delinquencies and loans that we're working out. And so flood insurance, all insurance, but flood as well, have doubled at least. And so greatly have impacted commercial customers when you're paying $75,000 and now it's $150,000 a year. So I would say that the economics have definitely changed a business or their borrowing capacity. And so there have been effects from, I would say, from expenses that have hampered continued mortgages or refining a mortgage.
Do you see a lot of those mortgages coming due with balloon payments, and how are they affecting the market?
I mean, I would say most mortgages are 5 or 7 years, maybe 10 years on the commercial mortgages. So they're not. So they're a 5 or 10, 7 year, 10-year term with a 25 or 30-year amortization, right? So you don't pay the whole mortgage off in the first 5 years, but so they're forced to refinance out of their loan unless they want to pay it off. And so that's what we've seen a lot lately is they've had to extend, right? Borrowers are trying to extend their loan to find a new somebody else to refinance them out of it. And to what Elaine said earlier about the insurance, lots of commercial property insurance has ballooned in most markets to where it's almost unattainable for many borrowers now, and it doesn't pencil. So property taxes have gone up, insurance has gone up, and rents might have stayed flat or maybe have gone up a little bit or down a little bit. So economics are a little bit different today than they were underwritten 5 years ago. So that's causing a lot of distress in markets. On the West Coast, I think Friday, there was a property that sold for $200 million in 2019, and now it's in the like $20 million range. So 90% drop in value because highest and use probably changed.
So your loan to value ratios are drastically increasing, right? Because the value is going down on a lot of these properties.
They can, yes. Mm-hmm. They can.
You just hit on a topic that maybe is affecting a lot of a lot of communities out there. So how do you see this affecting our market, the office, the shift in office, work from home, telework, hybrid work, or whatever you want to call it?
I think we've already seen most of the response from that. I think, a lot of companies are going back to some kind of a hybrid model. There's a push to go do that. So what it's going to drive is not necessarily just the offices that Justin's talking about, but what about all those mom and pop shops around the office, those coffee shops and so on and so forth, the flower shops that are around. That's where it really affects the business, the businesses, in my opinion. But as far as what's going to happen in the future, of course, who knows? We'd all like to have that, magic 8-ball. But I do think we're seeing a strive to have some sort of balance, hybrid type balance in the future. But I'm in the office 4 days a week usually, and at home 1 day a week. Most of us in our ops centers, they're trying to do a 1 to 2 day in the office week. Our Atlanta market actually just went to return to work. So everybody in the Atlanta group is all back in the office 100%. So even within our own company, we have different markets that do different things. So,
Mike, you mentioned the mom and pops. So we've seen a lot of the mom and pops not come back. I guess they're trying to reinvent what the ground floor retail looks like. And just today I was doing an assignment while I was reviewing it, working with an appraiser on it. And I'm like, why is rent so much less than last time we did the same exact one a few years ago? And it turns out that the brokers are being creative. Instead of saying, rent is, I'm going to use a number that may seem crazy to some of you, but $100 a square foot for above grade space. What they're saying now is your blended rate for above and below grade space is $100 a foot. So in essence, the rent, they're trying to get more, but they're being creative on how they're advertising it. And I found that, I'm like, oh, that's how they're doing it. They're not losing money. They're trying to get the same, but they're trying to entice you differently. So in, many retail markets, storage in the basement is thrown in to your above grade space. So you have 1,000 square foot retail using small numbers, and then you might have 500 square feet in the basement just for storage. But now what they're doing is instead of 1,000 square foot for the above grade space, they're calling it 1,500 square feet. And they're including that lower level space, and they're showing that their rent is not increasing. So it was $100 a square foot before. It's still $100 a square foot now, but they're not showing you that now they're including the basement that was previously not included.
Our markets in Boise and Texas, like Dallas and Austin did. Dallas and Boise never left. Like they didn't during COVID. Some of those cities never had a blip in terms of people going remote. Other cities, though, in the West Coast, Portland, Seattle, San Francisco, are recovering still and trying to get those people back there. But and some of these are in suburban markets too, it's not just the mom and pop. It's the dry cleaners. I mean, which could be, they could be chain nationals or not, but it's the bookstores. It's whatever you used to just go, next to on your lunch break, you're going to go grab something. If you don't have to go in anymore, you're not going to pick those things up. So the fact that we're trying to, I think people realize now how important the office workers were to the rest of the economy. And we've even seen our states, and like I'll say Washington, for instance, the state sent everybody home. The city of Seattle sent everybody home. Well, now they're wondering why their tax revenues are a lot less because all their employees, including state workers and city workers, were at home. Now that they have to go back to work, if they make them go back to work in these downtown or these any office core, whether it's suburban or urban cores, they're going to start seeing that there's a trickle down effect with taxes and goods sold. So
I wanted to give you guys a quick positive example of kind of the opposite of what you're talking about in real life. This is just one example, but one of my favorite coffee shops / kind of healthy juice, get smoothies and stuff in the morning right near me, a couple blocks away. It's literally husband and wife that for 2 or 3 years were working there. A building was built next door that took on 3,000 of what we call Excel Energy, our local energy company. They moved into that building. By the next week, this husband and wife had to hire 5 people just because of the influx of people for breakfast and lunch.
And with dry cleaning also, people don't wear suits like they used to. So they're not having their shirts pressed or suits cleaned as often. So it's change in, I think, life, our expectations of what we do when we go back to the office. So any last words from our panel today? Anything you want to talk about or address that we have not touched up on?
I got one thing that we talked about in Clearwater a little bit, and that is what happens to your appraisal after it gets reviewed and approved by your appraisal department. So, like Justin said earlier, it's not just that we're bored and we want to ask you lots of questions about your appraisal and make you do more work. That's not it at all. After our departments approve your report, we become your champion within the bank, and that appraisal, that report, whatever it is, can last forever. We get some that come back at, after a couple of years, after 3 years, after 5 years. And so you got to understand that all of this stuff we're talking about, with making sure you got that money paragraph, making sure you've got that highest and best use built out right, making sure you've covered the things that are going on in the markets, the insurance rates. My chief credit officer came to me a few months ago, a few months ago, and said, Mike, make sure that your appraisals are taking consideration insurance in their forward-looking expense ratios. So, other people within the bank have these, they use these, they get information out of them. And, as the appraiser, talking to you appraisers, you guys are the experts in the local markets. We need to have all that information so that we're solid. So we believe in you and we're solid. And then we become that champion and we fight for you on the inside. So keep that in mind. It's a team. We've all touched on that. This is a team sport, and that communication, that relationship, the information exchange, all of that is what makes that team work.
Right, that doesn't just apply to banks. I think it applies to all of our clients.
For sure.
We want to thank our listeners today for joining us, especially thank our guests for not only meeting with us in Clearwater, Florida at REVCO for a wonderful panel, but turning it into what I think is a great podcast. So Elaine, Justin, Mike, thank you. And Tonia, if anyone were to have an idea about what a topic might be for our podcast, what might they do?
Please reach out to us at facevalue@appraisalinstitute.org. Send us an email. We want to thank our current panel here, and we want to thank them for being with us in Clearwater. Just a reminder for everyone, Warren was recently at LDAC at Washington, D.C., so I'm sure he saw many of you there. And our next joint region meeting will be held in San Diego in early October, so hopefully we'll get to see more of our listeners out there. Thank you all.